All right, so the token maxing era, we're in that now. That's going to change the optimization era. The other open question for me is, are cheaper open source models going to be good enough? And like last year, it seemed like the answer was yes. And now this year, I'm not so sure.
First of all, I call it ROI maxing. So slight, more positive CJ today. I don't know if they'll be good enough. I think in some senses nobody wants yesterday's newspaper, but I mean when the tide goes down, sometimes companies are happy for what they can get at a certain price, especially if it's like we talked about on the prior podcast. How good do you have to be to overcome free? If there's someone out there who's going to give away some of this stuff and this compute for basically free, can it be 80% as good? Probably.
Yeah, when I think about from a vendor standpoint, so for the AI apps themselves, they could potentially do a little bit of shrinkflation, right? So they could charge one price and then realize, hey, we can deliver at 95% the quality at like half the cost by switching models, change out models under the hood, and then, see that margin kind of flow through to the bottom line.
Wait, I haven't heard the term shrinkflation in like 10 years. Is that when you get like a bag of Lay's potato chips and you're like, there's only 7 chips in here now?
Yeah, where it's like all air, so it looks like it's totally full, but then there's, like half the amount of Lay's chips.
Isn't there a term for the air that they put in it, like functional slack capacity? There's some like official term for it, but it's basically like a more scientific way to saying you're getting ripped off.
Yeah, the concept is like people like are maybe used to a certain price, and it's sometimes hard to raise prices, but you could keep the price the same and give the customer less and improve margins that way.
Yeah, my father-in-law said that at a place. He's like, the cheeseburgers around here definitely aren't 8 ounces anymore, but it's like the same price.
Exactly. Shrinkflation. So we'll see a shrinkflation era. And the other thing for me is, are enterprises going to push for bring your own tokens, or are they going to keep buying AI tokens through these application providers?
Oh, that's a really good one.
Because if they bring their own tokens, that kind of means like the AI costs are off the table for the vendor, but it also maybe means they're not really making money on the AI like they were before.
Wait, have any of the companies that you've talked to offered that as an option today at the application layer?
I have
BYOT?
seen a couple of companies offering it, but I have not seen anyone at scale doing that.
That's fascinating. It's kind of like we give you the car, but you got to fill the tank with gas.
Well, it's a lot of companies did this with infrastructure tools, right? If like instead of buying the infrastructure and the AWS bill, they would say, hey, we'll pay for your log management tool or whatever it is, but we're going to deploy it on our own private cloud and we'll pay our AWS bill or whatever it is. And so this has been happening in infra. I think it's just relatively new for AI.
I'm wondering though if that's cheaper, right? Because then it just matters how big your buying power is as the standalone company. Like I could see massive companies taking advantage of this, but if I'm little old me, I don't know if I can get better pricing power than like Post Hog if I'm using them on their credits. I'm guessing that they're buying up so much that it's a better rate than I can do.
Yeah, totally. I mean, I think that there's the buying power angle here. So maybe very large companies could save money, but yeah, your smaller companies are just not going to want to deal with the hassle and just have no buying power with the AI models. The other factor is like how much added value there is to buy tokens through the application. And so there maybe are applications that are good about figuring out when something should be open source or the premium model, and they maybe make that decision for you. And so if you just bring your own tokens, you're probably not going to have all that optimization layer built in, right? Or like they're not going to be as smart around using your token. So there's like, I think there's a question mark around how valuable like it is to the customer if they are on a BYOT or buy tokens to the vendor.
I can't believe I'm saying this, but the more and more I think about this gross margin question, the more I just come to the conclusion of, do we care? And I say that because the value of a business is predicated on its future free cash flows. And we're stopping at the gross margin line saying like, oh, this is shit. There's not much left over, but we haven't drawn it all the way down to profits and then a measure of free cash flow. And if you let that run out in perpetuity and you assume some terminal value here, I don't know what's in that bucket. I don't know the rest of the P&L. I think it's a different conversation if we're saying what happens if like everybody wants to get to at least 25% profit margins? That's always been like the nirvana, because then you only need 15% percentage growth rate each year to get to rule of 40. Oh, that sounds pretty manageable actually at scale. If you can still get to a rule of 40, but your gross margin is pretty gross, is that okay? So I don't know. I just come back to some semblance of like what the enterprise value is here. And maybe we were lied to all along, saying that software was valuable because it had high gross profits, even though a lot of these companies never got to free cash flow. Because at the end of the day, people are buying your product for what it will continue to do, not what it's just doing in that moment, which means you have to invest in R&D, which is usually the biggest capital crunch blocking you from getting to profitability.
The reason why we're talking about this is because as much as we've both said ARR is becoming increasingly meaningless in the age of AI, like companies are still bragging about their ARR. ARR is an important metric for investors. ARR growth is like the thing that everyone is focused on trying to deliver and then brag about in public. Because of this fixation on ARR, I think there's like some unnatural acts to try to get ARR, even if it's at the sacrifice of margin. When what really matters is like the overall profit dollars and the path to overall profitability. The margin could just be like the wrong thing to focus on, given what really matters.
Yeah, I think that's what we have to all come back to. What really matters here, right? Are we measuring the wrong thing?
Let me share an example of where I think things are going. So you know the company Toast in the restaurant tech space? So like a lot of restaurants use Toast. Toast has a subscription business line, a fintech business line, and a hardware and pro serve business line. Subscription business, 78% gross margins. Their hardware and pro serve business line, what's like kind of de minimis revenue, and it's negative gross margin. Their fintech business, which is a lot of payment processing, but some other stuff, 24% gross margins. So their revenue is very much fintech, but the margins, a lot of the margins come from the subscription SaaS revenue. And I just think that where we're going to go is that same kind of split. Like there's going to be the value add software that can still be high margin. There's going to be AI that becomes more of a pass through. That's like that 20-25% margin where you can make it up in revenue, but it's not super margin accretive. And then you probably have some other costs around the business that are more of an input to value. But my prediction for margins is 80-20 in that software and AI will bifurcate in terms of the margin profile. But where do you think things are going to go in 3 years?
It's a similar take than you. I would call it the age of non-consolidated financials, which means that you have to break out each of these. Toast does it because they're so different, but there are other companies out there that lump it all in, and then you just kind of have this blended gross margin. And you don't really know what's going on. So I really like your analog of saying there are companies out there that have a payments aspect to it that has a different gross margin profile than the subscription part. But if you add them all together, they're stronger as a whole. And it's not like you would look at it and say, oh, I'm not going to do payments because there's a lower gross margin. It's like, well, you're leaving so much money on the table if you don't. So this cost for AI, it may just be the cost to do business and to supercharge the rest of it.
Exactly. Like you're not going to not sell someone AI just because it's low margin. It's just you're not having your entire business model dependent on AI being the only thing you make money from. When I went all in on my newsletter Growth Unhinged last year, I quickly decided it was time to make the switch to Beehive. I chose Beehive because they're serious about powering the internet's best newsletters. Beehive's all-in-one platform brings together newsletters, websites, and every tool you need to grow and earn. And they keep making it better. You can now launch, host, and monetize your podcast entirely on Beehive. You can host webinars on Beehive. And you can access Beehive through the new MCP. I just use Beehive's MCP in Claude Cowork to audit my site, prioritize SEO fixes, and analyze subscriber trends. It's my newest obsession. If you care about owning your audience, Beehive is a no-brainer. Try Beehive for free by going to beehive.com. That's BEEHIIV.com. Use Kyle30 for 30% off your first 3 months.